How much Bitcoin is too much Bitcoin? Today, Wednesday the 5th of August, 2026, CoinDesk's crypto long and short newsletter finally put that question through a proper stress test. Gregory Mall ran Bitcoin inside the classic 60-40 portfolio, that is 60% shares and 40% bonds, and tested it across three very different market conditions: raging bull, grinding bear, and flat sideways drift. He compared a straight Bitcoin position against a basket of large-cap crypto assets. And here is the distinction most investors miss entirely. Allocation answers what you own. Position sizing answers how much you lose when you are wrong. Those are two completely separate decisions, and confusing them is why portfolios blow up. The timing is not accidental. Bitcoin slid to roughly $83,000 on the 29th of January, 2026, a two-month low at the time, and crypto long and short has already described the market as officially in a bear phase. That changes the maths completely. In a bull run, oversizing looks like genius. In a bear phase, the same position size quietly destroys a balanced portfolio, because Bitcoin's volatility does not shrink just because prices fall. There is a second story landing on the very same day. Analysts are reporting that a Coldcard hardware wallet exploit could push more capital towards regulated Bitcoin exposure, meaning funds and listed products rather than self-custody. That is a sizing question dressed up as a security question. So what does this actually do to people's money today? Three things. First, anyone holding Bitcoin as a small satellite position in a pension or ISA-style portfolio is discovering that the drawdown, the peak-to-trough fall, dominates their returns far more than their entry price ever did. Second, the self-custody debate has real cost attached now. If a wallet exploit pushes investors into regulated wrappers, they trade counterparty risk for custody risk and pay a fee for the privilege. Third, institutions are visibly recalibrating. Strategy, the largest corporate holder, paused purchases for the longest stretch in its company history, and Chief Executive Feng Liu has been publicly defending the model on CNBC. When the biggest buyer slows, price discovery gets thinner. In the near term, expect the sizing conversation to replace the price prediction conversation. The evidence points one way: regime-aware sizing, where your Bitcoin weight shrinks as volatility rises, held up better than a fixed allocation across the back-tested periods. Watch two signals over the coming weeks. 1. Whether regulated product inflows pick up following the wallet exploit story, which would confirm the shift towards custodied exposure. 2. Whether corporate treasury buying resumes, because that is the clearest read on institutional conviction right now. Here is the line to remember. You do not control whether Bitcoin goes up. You control exactly how much of your portfolio is exposed when it does not. Size the position so that being completely wrong is survivable, rebalance on a schedule rather than on emotion, and treat volatility, not conviction, as the variable that sets your weight. That is the discipline this research is really testing.